Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
So some about the benefits of ETFs are, again, they're very, very tax efficient. What I mean that, gang, is that, let's say it's August, here we are in August, was it the third year? If you were to buy a mutual fund tomorrow, because the market closed, it's almost 5 o'clock East Coast time, so if you want to buy a mutual fund tomorrow, let's say a Russell 2000 mutual fund, a small cap mutual fund tomorrow, through Fidelity, Schwab, American Century, Vanguard, whoever. It's August 3rd, and then let's say the mutual fund is up by December 15th, and the mutual fund wants to take some profit on some of the stocks that they're holding, again, because they're actively managed. The mutual fund money manager is trying to buy some small cap stocks and look at the next, LinkedIn or the next Google or the next Starbucks. So they're actively buying and selling. So we buy a mutual fund tomorrow, and net asset value at the close of business Thursday, 4 o'clock East Coast time. And by December 15th, it's up 5%. And the mutual fund money manager wants to take profits on some of the companies that they bought in January or February, earlier this year, 2011, a good 6-7 months before we owned the mutual fund. Well, when they do that, when they take profit on some of the purchases that they bought companies in January, February, March for that small cap mutual fund, we are responsible for those capital gains, even though we've only owned the mutual fund since August 3rd to be exact. So the mutual fund from January 1st to December 15th might be up, 15%, let's say. We're up 5% because we bought it August 3rd and we bought 5%, but we're looking at capital gains on all 15%, which sounds ridiculous, but believe me, this is the truth. Some of you are well aware of that, and you've heard about that, but some of you are probably not aware of that fact. So because they're actively managed, they're responsible for the capital gains, even though we've only owned the fund since August. Assuming we never get that back when the NAV exactly my right. So it's just something to keep aware of. ETFs are passively managed, so once they buy the stocks, getting back to the SMAs, once they buy the semiconductor stocks and they make it the SMAs, they're done. If one goes bankrupt or one is bought by another company and there's a merger, then we'll make an adjustment. But it's passively managed. They're not going to be actively buying and selling semiconductor stocks all throughout the year as opposed to the mutual fund. So it's a huge tax benefit gain. So that's the reason. So again, if you're I'll use an example of the small cap index, which is the IWM. That's the symbol for the Russell 2000 small cap index. Most of you are familiar with that, but in case you're not, the Russell 2000 is the largest. Is 2000 the largest small cap issues. The S&P is big cap, large cap, and the NASDAQ technology, and the Russell is the 2,000 largest small cap issues. So the IWM is the ETF that tracks the Russell 2000. So, getting back to this main slide, we're getting there's many tax benefits for ETFs versus mutual funds. Again, a big takeaway for joining us on this webinar this afternoon, if you have mutual funds at Vanguard, Fidelity, Franklin Resources, Hero Price, American Century, any of the big firms, find out that they offer a matching ETF. And if they do, I would seriously consider getting out of the mutual fund, selling the mutual fund, and purchasing the matching ETF for the tax benefits and for the lower expenses. Again, the more you reduce your fees or expenses, it goes right to your bottom line, and more money stays in your pocket, in your account. ETFs are very easy to diversify and target a sector or an index or a portfolio. Again, you can rotate, sector rotation, which we cover in our classes all the time in our XLT sessions. If you're going to rotate out of technology and financials and energy into some defensive sectors like utilities or healthcare, which, by the way, the two sectors that have been the strongest all year in 2011 since January 1st till August 3rd, are healthcare and utilities. I know healthcare stocks got slammed yesterday and Monday and Tuesday and Wednesday this week because of the the tragedies of the debt ceiling crisis and all that, and healthcare is going to be getting a lot of less government dollars. But even with that, utilities and healthcare, XLU and XLP, are two of the leading sectors this year. They have the leading sectors right now for a fact. And so the more you know about these 9 sectors that the S&P is spliced up into, utilities, healthcare, consumer discretionary, consumer staples, technology, energy, and financials. We're going to show you those slides coming up shortly, but the more you understand how the sector rotation works, it can help you with your investing and trading. So if you saw financials peaking in February and utilities and healthcare, a lot of money falling into utilities and healthcare, that's a big reason that money's falling into defensive stocks, and then they're getting out of technology, and then they're getting financials. That can give you some headwind on a big heads up or a red flag that they were probably going to get a 5 or 10 or 12 or 15% correction. And then that's exactly what we're in the middle of doing, right now as we speak, yesterday and today. I'm not sure about American Fund Mark. I know Vanguard they have a lot of matching, all Vanguard mutual funds are pretty much offering ETFs as well. Fidelity offers a few, and I know Vanguard, you're going to see the slide coming up shortly. Vanguard really beat Fidelity to the punch back in 05 with broadening their ETF offerings. So we're going to come up with that shortly. I'm not sure about American Funds. You might want to check their website or talk to your financial advisor at American Funds, or just call with the American Funds 800 numbers. So great question, though. I don't have big stuff at Vanguard, but I have a lot of familiarity with Vanguard myself personally. So with the ETFs again, it's very easy to diversify and target a sector like the bond sector, or healthcare, or utilities, or technology. Another defensive sector is consumer staples, XLY. No matter how bad the economy gets, people still need to buy toothpaste, mouthwash, and diapers, right? So consumer staples are a big defensive sector. So the more you know about these sectors, and hopefully I'm giving you some good nuggets this afternoon for joining us, but the more you know about these sectors, the big alpha sectors are financials, XLF, technology, XLK, and energy, XLE. The defensive sectors are consumer staples, XLY, XLU, utilities, and XLV, healthcare. Again, you're going to get all these symbols on a slide coming up shortly, I promise. So don't worry if you're not catching all of them as I speak. I'll spend some time on that slide, and you guys will have a good 5 minutes on that slide to write those down. So we can really need to diversify to the sector spiders or different sectors out there, semiconductors, bonds, crude oil. There's ETFs on commodities we're going to cover. So very easy to diversify a sector or an index or a commodity or bonds. They're very easy to sell short and buy on margin. There's no uptick rule. If you have a margin account, you can sell short. And if you have a margin account, you can obviously buy on margin. They're very flexible. Okay. They're easy to sell short if you have a margin account. Like I said earlier, if you have a cash account or an IRA account and you're not allowed to sell short because the government won't let you, you can buy an inverse ETF. The main inverse ETF that tracks the S&P 500, the symbol is the SH. There's no leverage, it's just 1-to-1. So if the S&P were down 2.5% like yesterday, then the SH would be up 2.5%. If the S&P eked out a 0.5% gain today, then the SH would be down 0.5. It's going to track the S&P inversely, percent for percent. The PSU we're going to cover shortly is the 1-to-1 inverse of the NASDAQ 100. So again, for those of you that have a cash account or an IRA and you're not allowed to sell short, and we're in the middle of a bear market, or the beginning of a bear market, or you're just trading them and we broke a trend line, or we're in a supply zone or any other bearish, news, you can go along the inverse 1-to-1 ETFs, which we're going to cover at length momentarily. SH and PSU. Most are really liquid with high bid-ask spreads, but not all. So the ones I'm going to show you, most of them are liquid with 1 or 2 or 3 pennies spreads in the bid offer, so they're very liquid. But I'll point out the ones that are not liquid yet, because there's not enough institutional participation, and there's not enough retail, investor participation just yet. So anytime you see low volume or low vol in parentheses, that means it does not do 1 million shares per day. I'll point that out again when we come up to those slides. Yes, Mark, we're going to cover 2-to-1 and 3-to-1 leverage. ETFs definitely, and there's been some lawsuits and liability and a lot of misinformation. So very good question. I promise we're gonna cover those. The 2-to-1 leverage versus ETFs and the 3-to-1 leverage, which I call the ETFs on steroids. Would you willing to send us the slide we requested? I really can't send. Well, yeah, I guess I can send one. If you request 1 or 2 slides, I can attach in an email to you guys. Yeah, my email again is dsugar@tradingacademy.com. That's SUGAR. There's transparency. You know what you're buying and selling. If you sell financials, if you sell the XLF, you're short the banks, the broker dealers, and the insurance companies. You don't have to worry about which one's going to go down the fastest or the furthest, which one's going to be strongest. You're short probably 15 or 20 or 25 stocks in that ETF. I'm not exactly sure how many. You can get all that information on their own websites, which I'm going to show you at the end of the presentation as well. You can find out, what is the XLF besides Goldman Sachs, Wells Fargo, Morgan Stanley, JP Morgan, Citibank, insurance companies are in there. What they're, not all of them are equally weighted, so like Goldman Sachs might be 3%, but Bank of America might be 7% of the XLF, so there's going to be a sliding scale of, percentages, okay? But there is transparency. If you're short the financials due to the XLF, you know you're short the banks, broker dealers, and the insurance companies. If you're long the XLK, you bought XLK, you know you have your exposure to technology. If you're long consumer staples because you're worried about a sell-off, if you think the S&Ps are going down 15 or 20%, consumer staples and defensive sectors are the place to be. They might go down, but they're not going to be down 30% like the broader market. They might be down 5% or 8%, and they might be up. If the S&P is down 30% by October or November, utilities, healthcare, and consumer staples might be up 5 to 10%, depending on how bad the bear market is. If it were to be a bad bear market. I mentioned consumer discretionary. That's another sector that does good in the bull market. What's in consumer discretionary? Those are like your, BMWs, your Acuras, your plasma TVs, things that we want but we don't need. So there's an ETF that tracks consumer discretionary. I forget the number offhand, but that's going to be on my sector rotation slide coming in shortly. So consumer discretionary are things we want, but we don't need necessarily. So we have analysis of the 3 main benefits of exchange traded funds are low fees. The annual fees on average ETFs are like 0.5%, which is 1/2 to 1/3 of many mutual funds. Okay, so really reduced fees. Many ETFs are 0.15% or less. All of those iShares we're going to cover, Vanguard ETF, their average is 0.18. So very, very cheap and inexpensive because they're passively managed. Tax efficiency, number 2, most mutual funds actively managed, ETFs are passively managed, so they have low portfolio turnover, as we've been talking about. They have less capital gains, or many of them have 0 capital gains. Those of you that read Barron's or Wall Street Journal or online a lot, you might see some ads for iShares, and it'll say, 35% of iShares ETFs have had 0 capital gains in the last 15 years. And then that's the truth. A lot of iShares ETF offerings are 0 capital gains because they are passively managed and they're not actively buying and selling the companies in the ETF. So very, very good information on the capital gains. The third main benefit, again, like we talked about, transparency of investments and diversification. You know exactly what you're buying and selling, and you can target a specific index, sector, or asset class. If you want exposure to China, you can buy the FXI, which is the symbol for the China ETF. If you want exposure to Brazil, the EWZ is the ETF that tracks Brazil. So we're going to show you these symbols again, I promise. I'm getting a little ahead of myself, but to show you the diversification for countries. I mean, emerging markets, the EEM is the exchange traded fund that tracks emerging markets. So, some of the markets that are not as mature as Japan or China or Canada or Australia, you can buy some emerging market exposure to the EEM. So, another question here, are any of the ETFs 60-40 long, short-term capital gains? Mark, great question. Futures and Forex are taxed 60-40, 60% long-term capital gains and 40% ordinary income. Not positive. The majority of the ETFs are going to be taxed just like stock accounts, but there might be a couple of exceptions like UNG, which is the natural gas ETF, or some commodity-based ETFs like SLV, silver, or USO. Some of them, because they're commodity-based ETF, might have that advantage of the tax benefits. So again, double check with some website, do your due diligence, but the majority of the ETFs are going to be taxed like a stock account. There might be some exceptions if there's commodity-based ETFs like gold, silver, oil, natural gas, etc. Okay, but great question, Mark. You're asking a lot of great questions. Some managers ETFs are better, more efficient investment structure that offer traders and investors a number of significant advantages. Immediate diversification with a single purchase or sale. Again, if you're short financials in February, March, you pick up 20% by, July 15th or August 1st. So you're short with one single sale. Short index exposure. If you buy the QQQs, the triple Qs, which is the NASDAQ 100 ETF that tracks in the NASDAQ 100, you're long basically technology. If you're long the QQQs, you're long technology. The QQQs are the ETF that tracks the NASDAQ 100. There's two main NASDAQ indexes you're probably aware of, but just in case if you're brand new investing or trading, there's the NASDAQ Composite, which is 3,000 or 4,000 stocks, and then there's the NASDAQ 100, which is 100 stocks, like the title says. It's 100 largest non-financial stocks that make the NASDAQ. So it's basically heavily weighted towards technology. You get, Whole Foods in there, Bed Beyond, some retailers, some supermarkets like Whole Foods, etc. But it's basically technology. Apple is 4% of the NASDAQ 100 because the NASDAQ 100 is market capitalization weighted. It's not price weighted like the Dow, which we'll get into later, but the S&P and NASDAQ is market capitalization weighted. So the larger the company, the larger the market capitalization, the bigger the weighting that stock has in the NASDAQ. And prior to May 2nd, NASDAQ, Apple was 22% of the NASDAQ 100. So it was 1/5 of the NASDAQ 100 was Apple. They rebalanced it like once a year, twice a year, depending on what's going on in the market. These index providers can rebalance their indexes or indices to reflect what's going on. And Apple was at 400 for 390. They wanted to rebalance, and Apple was only 12% of the NASDAQ 100, not 22 like it was 2 months ago, or 3 months ago, May 2nd. They did rebalancing. So if you buy the IWM, you're long, the largest 2,000 small cap stocks. If you're long the diamond, DIA is the symbol for diamonds. DIA is the symbol for the Dow Jones 30 Industrials. So if you're long the diamonds, you're long the 30 Dow stocks, 3M, Caterpillar, Bank of America, American Express, McDonald's, Merck, Coke. So the diamonds are the ETF that tracks the Dow Jones 30. You're not able to trade these four big cap indexes, the Dow, S&P, NASDAQ, and Russell. You can't buy and sell those cap indexes. What you can do with futures, ETFs, etc., is just buy them with an ETF, or the futures. So there's index ETFs that track Russell, Dow, S&P, and NASDAQ. For managing your portfolio, it gives you a lot of flexibility, whether there's 9 different sectors players, or the DLP, bond ETFs, or commodity ETFs, or emerging market ETFs. You can really do a lot of good things with your portfolio management and several rotation, a lot of flexibility. So they're transparent, they have low expenses, and they're very tax efficient. And here's a little humorous stocks are getting cancer, and reasons to trade ETFs. You're also familiar with some of these stocks and their symbols, Delta, AIG, Bear Stearns, Enron, Lehman Brothers, Fannie, Freddie, WorldCom, and Geico, whatever those companies, they vaporize because of greedy CFOs or CEOs or presidents. And, one of my big examples of a reason to trade in these ETFs versus in individual stocks was take a look at the, British Petroleum when that news hit, what was it, 2 years ago for the oil mess in the Gulf of Mexico. BP stock got slammed, right? Whatever, 20, 30, 40% in a couple of weeks, down from the panic, from the oil split and the oil stove. But the XLE, the energy that BP is included in, that may go up 3% or 4 or 5% because of BP, but it didn't go down 30 or 40%. So you don't have the single stock risk. Systemic risk, so no single risk for fraudulent CEOs or CFOs, or any bad news in the media. If regarding any specific news about a CEO like Warren Buffett or Steve Jobs with Apple, you're not going to have that risk if you're long XLK technology and then not Apple individually. So just keep in mind on that. So you don't have exposure to these companies that went bankrupt, Lehman Brothers, Bear Stearns, Enron, Adelphia, House, and those type of companies. What can we get against FCC and confidence? That's difficult. The new ETF, the second universe of FCC and confidence, but hopefully with FINRA and some other, regulations through the industry, that's funded by the industry, through the NIA and so forth, and the stock companies and broker-dealers, hopefully they'll be a little bit more confident. But yeah, there's definitely incompetence of the SEC. So who uses ETFs? Institutional investors, pension plans, foundations, endowments, University, Stanford, University of Michigan, Harvard, Yale, some of these big endowments, they're big into the ETFs. Mutual funds and money managers, many mutual funds use ETFs either as a speculation or a hedge as well. Plain individual investors like you and I, IRAs, rollovers, 401ks, taxable accounts, active traders, day and short-term swing and position traders are all contributing to the phenomenal explosive growth in exchange-traded funds. Okay? We can take a look at some questions here. Speaking of your experience, how can I find out the composition of the ETF? Could you explain? Oh yeah, great question, Ron. To find out what holdings are in the XLK or which utility companies are in the XLU, I'm going to show you a website coming up shortly. It's sectorspider.com, sector, S-D-C-T-O-R, spider, S-T-D, I'm sorry, SPYDR, sectorspider.com, or just Google or Bing or search NOL for sector spiders, and you'll get the sector spider website. You can find out the holdings of what's in the different sector spiders, what companies are in the XLK, what energy companies are in the XLD. Great question. If you're going to search for like the SMH or the TLP or some other ETF that's not the sector spider, you have to get that information from the ETF sponsors website like ProShares.com, iShares.com, PowerShares, Invesco, which is the sponsor of QQQs. I'm going to give you one of the last slides today again. It's going to be a bunch of websites, Bloomberg, MarketWatch, where you can get the sponsors and find out what exactly stocks are in the ETF and what percentages. Okay, so great question.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.